Welcome back to the Deep Dive. It's September 9th, 2025, and today we're focusing squarely on Bitcoin. There's this real sense of anticipation in the air.
Definitely. It feels like the market's holding its breath. A lot of people check Bitcoin daily. It's like a ritual, and today feels particularly significant.
Exactly. And the big story today is this major consolidation. Bitcoin's holding incredibly steady, right above that key $112,000 level.
But it's not just quiet sideways trading, is it? It feels more dynamic than that.
Right. That coiled spring idea we talk about. You've got these really powerful forces pushing and pulling, building up tension. Feels like something big is coming.
And those forces seem to fall into, what, three main camps?
Yeah, I think that's a good way to put it. First, you've got the institutions. They just keep buying. Corporations, maybe even some governments, quietly accumulating. It's creating this solid floor under the price.
Like a bedrock of demand.
Precisely. Then second, there's the regulatory side, particularly in the U.S. It feels like we're finally getting some real clarity, some legitimacy. That's huge.
It absolutely is. Reduces uncertainty for the big players.
And third, the immediate thing everyone's watching, the macro picture, specifically key U.S. economic data that's due out. The market's kind of treading water waiting for that because it could really sway the Fed.
And that means potential volatility, right? Even if the long-term trend seems clear.
Exactly. That's the coiled spring. Strong fundamentals pulling up, macro uncertainty holding it down. The resolution of that tension is what we're all watching for.
It's fascinating how these long-term trends manifest day to day. One piece of good news might not send the price soaring like it used to.
Right.
But add it all up, the cumulative effect, it's undeniable. That spring is definitely getting tighter.
Okay, so let's dive into the specifics. Right now, Bitcoin's trading, around $112,500. Pretty tight range.
Yeah, modest gains, maybe 1% or so in the last 24 hours. Technically, it's bumping up against resistance just under 112K, around $111,922.
But the support underneath looks really solid, right? That's the encouraging part.
Very solid. There's a strong cluster down around $111,000. It's where the 20-day, 50-day, and 100-day exponential moving averages, the EMAs, are all converging.
Okay, so multiple time frames agreeing on support. That tells you the medium-term uptrend is still intact.
Exactly. And this sideways action, this consolidation, it's not weakness, it's construction.
Construction? How so?
The bulls are building a base, laying the groundwork, you could say, for another push higher, maybe to retest those upper resistance levels.
Makes sense. Are other indicators showing anything?
Well, the MIS-CD, the Moving Average Convergence Divergence, is showing a slow, gradual, bullish crossover. The histogram bars are ticking up, suggests some building upward momentum on shorter time frames.
Interesting. And market sentiment?
Pretty balanced, actually. The Fear and Greed Index is sitting right around 51, neutral. No extreme panic, no wild euphoria, just watchful waiting.
So analysts are thinking maybe a small pop soon.
Some are projecting maybe another 1.5% to 2% push in the next day or so, maybe targeting $113,500. But the key level everyone's watching is getting a sustained close above that $113,000 to $114,000 zone. That would be a strong confirmation.
Okay, but here's the rub, right? This technical strength is happening in a really low-volume, cautious environment.
Absolutely. And that caution comes down to one thing mainly, that upcoming U.S. jobs data revision.
Yeah, the Bureau of Labor Statistics is releasing its preliminary revision for the 12 months ending March 2025. And the estimates for the adjustment are, they're all over the place.
They really are. Some analysts are expecting a downward revision of maybe 450,000 jobs. Others are saying it could be as high as 950,000 jobs wiped off the previous counts.
That's a massive potential difference, and the market hates uncertainty.
Totally. And if you connect this to the bigger picture, this jobs number isn't just about history. It feeds directly into the Federal Reserve's thinking on interest rates.
Right. So let's play that out. Scenario 1. The revision is big. Jobs numbers look much weaker than we thought.
Yeah.
What happens then?
Well, that reinforces the narrative of a cooling economy. That probably increases the odds the Fed gets more aggressive with rate cuts.
Okay.
Which in turn likely weakens the U.S. dollar. And when the dollar weakens, capital tends to look for alternatives, often flowing into risk assets, like Bitcoin.
Got it. So weaker jobs, maybe paradoxically, boosts Bitcoin.
Right.
What about scenario 2? The revision is smaller, or maybe the numbers are even stronger than anticipated.
Then it signals the economy is more resilient than thought, That might give the Fed reason to pause, to delay rate
What
cuts.
do you mean?
Probably a stronger dollar, at least in the short term, and that usually acts as a headwind for assets priced in dollars, including Bitcoin.
So that explains the tight range. You've got the short-term traders nervous about the Fed playing it safe,
Exactly. Highly sensitive to that macro data.
while the long-term holders, the institutions, are just steadily accumulating underneath, providing that support.
Precisely. That's the tension. It even overcomes the usual September blues for risk assets. Historically, September is often a week of month.
So what does this mean for you, the listener, watching this play out?
It likely means that any dip we see, say, if the jobs data spooks the market short term, is probably going to get bought up pretty aggressively by those long-term players. We could see some sharp V-shaped recoveries if there's any sudden weakness.
Okay, good perspective. And just a reminder, we'll put a summary of those key price levels, support, resistance, the current range in today's show notes for you. Now let's shift gears a bit and talk about that relentless institutional force.
Yeah, the adoption story just keeps unfolding.
Surf's up. CoinShares. Big news there. They're a major European digital asset firm managing like $10 billion.
Huge player in Europe.
And they're going public in the U.S. on the NASDAQ via a SPAC merger, valued at $1.2 billion, expected by year-end. What's the big deal here?
Well, the headline is really access, direct access to U.S. capital markets. That's the biggest pool of capital in the world.
Right.
So it lets CoinShares expand massively, positions them as one of the biggest publicly traded digital asset managers anywhere. And for the market, it's another big step towards mainstream integration, more legitimacy, more infrastructure being built out in the regulated space.
Makes sense. And on the sovereign front, El Salvador made a symbolic move.
Yeah, marking the anniversary of their Bitcoin law, they bought another 21 Bitcoin.
Which is, what, about $2.3 million? Not a huge amount in the grand scheme?
No, the amount isn't the point. It's the symbolism. It's President Bukele saying, we're still committed, despite all the international noise. For the long term, it keeps that narrative alive, Bitcoin as a potential neutral reserve asset for nations, maybe an alternative or supplement to gold.
Now, here's something that really jumped out at me from the research. Corporate treasuries. They're buying more Bitcoin than the ETFs.
Isn't that fascinating? For 3 quarters running now, publicly listed companies have put more Bitcoin onto their balance sheets than all the U.S. spot Bitcoin ETFs combined have absorbed.
Wow. What were the numbers for Q2?
In Q2 2025, corporates added about 131,000 BTC. The ETF took in around 111,000 BTC.
And the total corporate holdings are getting pretty significant now.
Absolutely. Last count, 61 public companies hold over 848,000 Bitcoin. That's like 4% of the entire circulating supply.
Just sitting on corporate balance sheets.
And that, I think, is maybe the most powerful long-term bullish signal right now, because that capital is sticky.
Stickier than ETF money, you mean?
Yeah, exactly. Buying Bitcoin for your corporate treasury is usually a strategic long-term decision. It's integrated right into the company's structure. It's not like shares in an ETF that can be traded in and out quickly based on market sentiment.
So it's less likely to flood back onto the market during downturns.
Much less likely. We're seeing this new category emerge, Bitcoin treasury companies. Think MicroStrategy, obviously, or Metaplanet over in Japan. Their core strategy involves accumulating Bitcoin.
Which is different from companies just using crypto like Robinhood for trading.
Right. And for you as an investor looking at these companies, it means traditional metrics like earnings multiples don't tell the whole story anymore. You need to start looking at things like Bitcoin holdings per share. It's a real structural shift in how we need to think about value.
A whole new way to analyze companies. That's fascinating. Okay, let's pivot to that regulatory landscape, which seems to be moving faster now. The U.S. Congress is asking for a report on a national Bitcoin reserve.
Yes, specifically asking the Treasury Department for a detailed plan. How would they actually hold a strategic U.S. Bitcoin reserve? Logistics, custody, security, all the practical stuff.
And this builds on that earlier decision to just hold on to seize crypto, not sell it off immediately.
Correct. That was the first step back in March. Moving from an executive order to asking Congress for a Treasury report makes it feel much more durable, potentially bipartisan, less likely to change with political wins.
And the implication for the market.
Huge legitimacy boost. If the U.S. government is seriously planning to hold Bitcoin like it holds gold, that's a massive signal to institutions worldwide. It de-risks the asset significantly.
Then there's NASDAQ. They want to trade tokenized securities.
Yeah, they formally proposed it to the SEC. We're talking digital versions of stocks, ETFs, traded right on the main NASDAQ exchange.
That sounds like a pretty big deal.
It's a potential watershed moment. First time a major U.S. exchange has gone this far. It signals that convergence of TradFi and DeFi we keep talking about.
What are the benefits they're pitching?
Potentially much better liquidity, faster settlement times, maybe easier access for more people. And for Bitcoin, even though it's not directly about Bitcoin, it's a huge validation of the underlying blockchain technology.
Okay, and speaking of mainstream, Robinhood joining the S&P 500.
Right, effective September 22nd. Their stock popped nearly 14% on the news.
And a lot of that success comes from their crypto trading business, right? Especially with the regulatory climate getting a bit friendlier, like the SEC dropping that investigation.
Absolutely. And the significance here is subtle but important. Once Robinhood is in the S&P 500...
Every index fund has to buy it.
Exactly. Every S&P 500 tracker, pension funds, institutional money following the index. They all get passive exposure to a company whose fortunes are pretty closely tied to crypto trading volume and sentiment. It just weaves crypto deeper into the traditional financial fabric.
And one more government-related point.
Yeah.
That transfer of the seized Bitfinex Bitcoin, about $1 billion worth, moved recently.
Yeah, and seen through this new strategic reserve lens, that's not just moving evidence anymore, it's basically funding the reserve.
Ah, okay. So they're taking Bitcoin that was already off the market and formally earmarking it for long-term holding.
That seems to be the implication. It takes a known potential supply overhang off the table permanently and physically capitalizes their hold strategy.
So the U.S. strategy seems twofold then. Promote regulated dollar-backed stablecoins to keep the dollar strong.
Right, like the Genius Act pushing for full cash or treasury backing.
And also build a strategic Bitcoin reserve as a kind of non-sovereign hedge, like digital gold.
Exactly. It's not an either. It looks like a strategy to dominate both the traditional and the emerging digital financial rails. Pretty smart, actually.
Okay, let's shift from the macro and regulatory down to the network itself. Mining. Any interesting updates there?
Yeah, we got some ground-level insight from Canaan Inc., one of the big hardware makers. They reported mining 98 Bitcoin in August, which was up 10% from July.
And their deployed hash rate?
About 8.6 exashash per second. That's a lot of computing power. They also mentioned holding almost 1,550 Bitcoin in their treasury.
And they're expanding geographically.
Into Southeast Asia, Ethiopia. And they really emphasized their focus on energy efficiency, getting more hashes per unit of energy.
So what does all that tell us?
Well, it's a snapshot of the broader trends. Hash rate keeps growing globally, meaning the network's getting more secure. It's decentralizing geographically, which reduces risk. And the whole industry is obsessed with efficiency, which is key for profitability and sustainability. It shows a maturing sector.
Now, speaking of mining, there was that incredible story about the solo miner.
Oh, yeah, that was fantastic. A real David and Goliath moment, almost.
Tell us about it. This miner had almost no chance, statistically.
Practically zero. This individual was mining solo with just 200 terahashes per second of power. I mean, that's tiny compared to the big pools.
Like a rounding error on the network total?
Pretty much. And yet they successfully mined block hashtag 913,593 all by themselves, got the full reward, about 3.13 Bitcoin, worth around $347,000 at the time.
And the odds were astronomical.
Like 1 in 36,000 on any given day. Statistically, something that should only happen to someone with that little hash rate maybe once every 100 years. And this happened while network difficulty was hitting new all-time highs.
So what's the significance beyond just being a lucky break?
It's a powerful reminder of Bitcoin's core nature. It's permissionless and probabilistic. Even with massive industrial miners dominating, anyone, literally anyone with the right setup, still has a non-zero chance of winning the lottery. It pushes back against fears of total centralization.
Reinforces that decentralization ethos. Cool story. Okay, let's touch on security briefly. There was a bit of a scare involving the software supply chain.
Yes, a pretty sophisticated attack targeting developers via NPM, the Node Package Manager. It's where developers get lots of standard code libraries.
How did it work?
Someone phished a developer's login credentials and then injected malicious code into at least 18 popular JavaScript packages. This code was designed to steal crypto from users of any application that unknowingly included these compromised packages.
Oof, that sounds bad. Ledger's CTO even put out a warning.
Yeah, an urgent one. Because this kind of supply chain attack is insidious. It doesn't target you directly, it targets the building blocks developers use.
Like poisoning the well upstream.
Exactly. One bad component can spread silently to thousands of apps and wallets. It really highlights the risks in relying so heavily on open source code and the need for constant vigilance and better security auditing.
But the damage was limited, right?
Thankfully, yes. The crucial follow-up is that the threat was spotted and contained very quickly. Reports suggest there were almost no victims.
So a good outcome from a bad situation.
I think so. It actually shows the ecosystem security is maturing. You saw quick coordination between researchers, the platform provider, NPM, companies like Ledger. They shut it down fast. It's like the industry's collective immune system getting better at fighting off these threats.
Okay, that's somewhat reassuring. So wrapping things up for today's deep dive, the main takeaway is still this tension, right?
Absolutely. You've got these really strong, long-term bullish fundamentals. The corporate buying, the sovereign interest, the regulatory clarity finally emerging.
Pulling the price upwards, fundamentally.
Right. But then you have this near-term macroeconomic uncertainty, mainly around the Fed, and that jobs data acting like a lid, keeping things cautious, holding that coiled spring tight.
So what should people be watching most closely in the next day or two?
Number one is the immediate reaction to that U.S. jobs report revision. How does the market digest it? And critically, does that $112,000 support level hold if we see volatility?
Okay, what else?
Keep an eye out for any more news on institutional buying. Any new corporate treasury announcements or whispers of sovereign interest just reinforce that underlying demand.
And regulatory news.
Yeah, any updates on the Treasury's Bitcoin reserve report or the SEC's view on NASDAQ's tokenization plan? Those could be significant de-risking events.
Makes sense. So lots to watch.
Indeed. And maybe a final thought to leave folks with. As we see Bitcoin making this transition, from niche digital oddity to something being integrated into global finance and even national strategies, we're not just watching a ticker symbol. We're seeing this deep interplay of finance, technology, even geopolitics. The big question isn't just if Bitcoin survives or adapts. It's how profoundly it's going to change the system as it becomes part of. What new ways of measuring value, what new kinds of companies will emerge from this? It's a fascinating evolution to witness.